Hi everyone, just Tony here. Today we're taking a very close look at the gold market. There is possibly a major short squeeze opportunity arising in the near future. We're going to be taking a very close look at the fundamentals and technicals that are happening behind the scenes and try to understand what's moving the market and where it may go to in the short, medium and long term. So firstly, what actually drives the price of gold? So gold has that perception as a inflation hedge. However, gold is really a hedge against real interest rates. So gold performs extremely well when the real rate, which is the nominal rate minus inflation, decreases in value. So you can see the major gold bull market, which happened in 2000 or began in 2000, that was when the real rate moved into the negative territory and it declined to roughly minus 3.76%. When the gold hit that peak and the real rates bottomed out and began moving higher, gold obviously entered a bear market and bottomed out around 1,000, and that was when real rates increased to minus 0.83%. Since then, the real rates have continued to move further into the negative territory, a mixture of central banks decreasing interest rates and also inflation rising, which has been a main theme since COVID occurred back in 2020. So since then, real rates kind of bottomed out at minus 6.87%. And since central banks have been increasing interest rates, what we can see is gold has sold off heavily from 2,080 to roughly 1,680. Now, if we take just a look back at why gold peaked at 2,080, that was mainly due to the Russia-Ukraine conflict. So gold also performs well during times of war and economic uncertainty. So, we have had that period recently now where rising interest rates have put downward pressure on gold, and that's because the real interest rate in the market has been moving gradually higher as central banks have increased their interest rates. However, if we take a look at what's happening behind the scenes, we can see that the open interest and orders in the market kind of gives us an understanding as to how bullion bank dealers are positioning. And right now, swap COMEX short positions are at the lowest level in a number of years. Net shorts have reduced from roughly 50 billion to 12 billion, and this tells us the total number of short sellers from the bullion level has declined significantly. So there's fewer bearish participants on the metal at the moment. Now, if we go to what's happening from the COMEX vault level, the vault totals are decreasing. Okay, so they haven't been this low since May 2020. There's been 26,000 COMEX contracts that have stood for delivery, which is over 80 tons of gold. Central banks have added roughly 50 tons of gold to their gold reserves, and the bullion short positions are decreasing. So we have, on one hand, we have big players in the market which are standing for delivery, so the vault is being drained. We then have the bullion short net positions are decreasing as well, so they obviously know something behind the scenes that there might be something occurring over the short to medium term. Now, if we take a look at what's happening from the managed money perspective and in the futures market, managed money is currently net short on COMEX futures. This has only happened 6 times previously in history, and there's only been one occasion when the value of speculative bets against gold has been this large. So there's an extreme bearish sentiment from managed money, and they are overplaying or overly bearish on the price of gold. So this sets up what we call a short squeeze opportunity. A short squeeze is when the market rallies higher to liquidate the short positions in the market. Now, we already know that the big players are standing for delivery. We already know the bullion dealers are decreasing their net short positions, but managed money, who, these guys can get it wrong. They are overplaying the short side of the market. So they're extremely bearish on the metal at the moment. Now, the value of the speculative bets against gold is the second highest on record. So this didn't actually, the levels haven't been this significant since 2018. Now, the last time this occurred, gold entered a major bull market. So we can see a period of consolidation similar to what's happening now. Managed money had their largest net short position, and there was a huge short squeeze opportunity happening in the gold market. So gold rallied higher and kind of took out all of the net short positions from managed money. Now, if we take a look at the 6 times this kind of signal has happened previously, over a 52-week period, 5 out of the 6 times there has been a major bull market or a positive return. Now, if we take a look at the time when that didn't occur as well, there was a kind of a 0% return a year from the signal. However, throughout that year, there was times of a bullish market as well. So it did reach, a 12% return in the gold market. The average return following a signal of managed money, taking a net short position was roughly 20%. Okay, so we're going to keep that in mind for the analysis in the future. Now let's dive into the technical side of gold. We do a lot of Elliott Wave theory, and this is kind of our analysis, our bullish analysis, and we see that gold has potentially completed a sideways correction, an ABC correction. The reason we think this is because of this triangle formation in here. So a triangle in Elliott Wave theory can only occur in a wave B. So we've had an A wave correction from this low, an A, B, C, D, E, and then a C wave rally to create a double top. So we do know that this is a B wave corrective rally. So what that means is this decline is also corrective. It's part of an A, B, C correction. And we've potentially had a 5 wave decline, which indicates that the C wave correction has completed. So if we dive into that correction in a bit more detail, we can see a 1, a 2, a 3, 4, 5 to potentially complete a C wave decline of a wave 4, which indicates a new bull market could be on its way soon. And we've already identified the fundamentals behind it. So we understand that it could be a short squeeze opportunity. We know that, of the 6 times this signal has happened previously, there's been a major bull market and a positive return in the coming year. And what we can see in the short term is a possible 5 wave rally from the low. So this is the first signal that a new bull market is potentially underway. We have our bullish invalidation level set at 1680. Any move beneath that level is going to invalidate this Elliott Wave analysis, and we'll have to reassess at a later stage. So how to kind of trade this or how to play this in the coming weeks? We can see a 5 wave structure to the upside. What we now need to see is a corrective decline, an A, B, C decline. That will set up a higher low in the market. That will give us confirmation. A 3 wave decline is a confirmation of a corrective decline, something we can possibly buy into. So we need to see an ABC correction, possibly into 1750, 1730. We can then start considering going long on the precious metal, either above the B wave top or above the 1810 top in the market. There may also be opportunity to play this through mining stocks if you're a stock investor, through gold ETFs as well. But if gold does perform, using the average performance following a signal of managed money net short positions of a 20% return over the coming year, that could take gold into 2,125 over the next year. Okay, so obviously that's a long-term play for a year. We generally focus on short to medium-term movements in the market. So our kind of initial thought is to wait for a corrective pullback in the market before we consider going long in our FX account or in our trading account on the precious metal. We'll also be looking to add some positions to gold miners as well over the coming weeks. But a big opportunity here, guys, on gold. If you have any questions on the analysis, please reach out or drop a comment in the comment section below. Cheers.